Okay, good evening. It's 6:50, so let's get started. We just did quiz 1, and tonight what I'm going to do is 10.7. I'm going to finish chapter 10, which I started last week. There's no announcements, but if there's anybody that has questions about anything, yeah?
The group project you said you talked about?
Yeah, well, I'm waiting on Santa to put it out, but it should happen pretty soon.
That's due in 3 weeks still?
Yeah.
And we have to give you a list of our members.
Yeah, who does not have a group yet? Okay, you should start talking among yourselves to figure this out right now. Maximum 4 per group, but my suggested team size is 2. You're allowed to do it by yourself if you want, but like I said, a team of 2 works really, really well. You have another question?
Yeah, do you want to put our group members like Busi or give your sheet?
Just email it to me. And then when you do your group assignments, you only end in 1. You don't end in 1 for each. So just 1 for the whole group. Anything else? Yep. Yeah, I'll put them up on CU Learn probably later this week. Yeah. Yep. Yeah, well, what happened was the TA was sick. He was in the hospital, so he couldn't do them, so I did it myself. But I was at a conference Saturday, Sunday, so I couldn't do them until Monday. I'm sorry, but I couldn't do them until yesterday. But most of you studied the night before anyway, so what difference does that make? Right? So. But for the first one, if any time, like sometime, some, accident happens or whatever, things don't get done, when you go on YouTube, you can just watch me teach that same course 3 months ago. It's pretty much, I polish up a little bit the slides, but there's not that big of a difference. So usually the TA gets them done by, somewhere between Wednesday and Friday, but he was really sick last week, and, by the time the weekend came around, I was completely booked, so I had to do them on Monday. That's the best I could do. But you can always go and on my YouTube channel, just you could watch the whole course for the whole term right now. It's already up from the past term. There's not a lot of differences. Anything else? Okay, so we'll get started. So last week I did, well, it looks like I did most of 10 because I did 6 sub-chapters, and I'm only doing 1 tonight. But the one tonight, there's a lot more heavier maths. So in the past, when I've tried to teach this whole thing in a single lecture, it really felt cramped. It really felt like I was rushing way too much at the end, and it wasn't that clear for students to. So last week I did 10.1 to 10.6. So we talked about cash flow. You're going to hear that expression over and over and over again in this course. Talked about incremental cash flows. So when you do a financial analysis to make a decision, you look only at the cash flows that would happen if you make that decision and the ones that don't if you would not make that decision. If something's going to happen, whether or not you take the decision, then that's not a relevant cash flows, an incremental cash flow to the decision you're looking at. Then I talked about pro forma financial statements. For the accountants in here, make sure you don't get confused that pro forma means 2 different things in accounting versus finance. In accounting, it means a company that's presenting their earnings in a non-GAAP way, usually to illustrate some way of looking at the business, or non-GAAP or non-IFRS now. It's basically a deviation from the standard. Maybe it's a different way of recognizing revenue. Maybe it's GAAP tells you to expense something, but you're showing it as a capitalized or vice versa. So that's in accounting. In finance, pro forma means anything that's forward-looking. So if you do a business plan and you do a cash flow forecast, that's what's called a pro forma. It's if things go according to plan, then your balance sheet and your income statement will look like that after you've executed that plan. Then 10.4 and 10.6 were go a little bit together. which is a big comprehensive example in the textbook. That's done first using the basic operating cash flow way, and then in 10.6 I showed you how you applied the what's called the tax shield method. And the punchline there is, instead of summing up the cash flows, subtotaling the cash flows for each year, and then taking the net present value of that series of cash flows, instead what you do is you take the net present value of each line of the spreadsheet, and then you add the present values to get the net present value. So that's how you do it in 10.6, and it's very useful because you'll see today when we do bid price, that's the only technique that you can get to the answer. If you use the basic way, you would have to solve like 5 equations with 5 variables. It'd be ridiculous. Alternative definitions of operating cash flow. So pro forma. Those are two very fundamental equations that we're going to use. Operating cash flows, EBIT. You add the depreciation because it's non-cash, but you subtract taxes because taxes you have to pay. That's money that you have to pay out of your bank account or your pocket all the time. And the cash flow from assets, from the point of view, from the internal point of view, is operating cash flow minus net capital spending minus changes in net working capital. It's also equal to cash flow to the creditor plus cash flow to stockholders. The alternative operating cash flow is quite an important measure, and there's actually 4 different ways to get to it. There's the basic, there's the bottom up, there's the top down, where what you do is, because you're trying to get to a cash flow amount, when you subtract your costs, you only take cash costs, so things which you're paying. So the main example, the main one that's not included in that is depreciation. So when you do the top-down approach, you would do sales minus cost, but not include depreciation because that's not cash that's coming out of your pocket. Obviously minus taxes. But the most important one was this tax shield approach. What you do is you separate the cash flow effect of having depreciation from the rest. So you look at the total after-tax cash flow. So sales minus cost, that's your pre-tax cash flow. Remember that anytime you multiply by 1 minus t, you're converting something from pre-tax to after-tax. So the first part of that equation is the after-tax cash flow, ignoring the depreciation. The way that depreciation influences cash flow is you would think depreciation is an expense, so that would give me less cash, right? It's an expense. It reduces the amount of money that I have. But in reality, what happens with depreciation is, because you have that CCA deduction, it reduces your tax payable. That's called a tax shield. So if you take whatever the amount or depreciation or CCA, and you multiply, if you just take the CCA by itself, that's called CCA. But if you take the CCA and you multiply that by the tax rate, that's called the CCA tax shield. Tax shield meaning that's the amount of tax that you save. So let's talk, just review. I showed that to you last week, but I want to make sure this is clear. When you have CCA, there's two things that can happen. You can have either straight line or declining balance. Now, if in your first year accounting course, you probably looked at all kinds of other depreciation method. There's things like, activity based. If I have a piece of machinery, then what I'm going to do is depreciate it, say, based on how many units it produced in a year or something like that. That's nice for accountants, but for tax purposes, there's only 2 methods that apply: either declining balance or straight line. And most, I would say maybe 80–90% of CCA classes are declining balance. The only ones that I'm aware of that are straight line are leasehold improvements. So if you rent something, then the amount of money that you spend fixing it up before you move in, you amortize or depreciate. I'm not sure if leasehold improvement would be considered tangible. So you depreciate over the life of your lease. The other one that's straight line is a franchise. So if you buy a Tim Hortons and it costs you $100,000 to buy the Tim Hortons franchise for, say, Carleton University, and that franchise has a 10-year term on it, then what you would do is depreciate it, amortize it by $10,000 each year. It's not that in your first year that you operate, you get a deduction, a cost, an expense of the whole $100,000. It's the cost of the franchise is spread over the life of the term. So when you have straight line, it's extremely simple. Remember, we have three different concepts. CCA, which is what you deduct in a single year. CCA tax shield, which is what you saved in tax from having that deduction. And present value of the CCA tax shield, which is all your savings over the life of the project, you take the present value of that. So when you have straight line, it's extremely simple. It's just an annuity, where you have constant cash flows. Is that a cell phone going off? Okay, can you please make sure that it's turned off? Thanks. So here we have straight line, 30,000 over 3 years. That means that the CCA is 10,000 each year. If you have, does it say here? Well, in the case of leasehold improvement, you don't need to explicitly say that it's straight line to zero, because you can't keep a balance after your lease is over. But sometimes you might have something where you have straight line but to a salvage value. So it's a little bit more complicated to figure out what it is each year. But when you have straight line to zero, it's really simple. It's just whatever the total amount is divided by how many years you have. Yeah.
You know when there's like the problem with net present value of the whole thing, the whole project, so you would add like the present value of the tax shield to that?
Yeah. You'll see 2 examples today where I'm or more where I'm doing that. So if you have a CCA deduction of $10,000 each year and your tax rate is 20%, that means that you're saving $2,000 in tax each year. That's a cash inflow, right? What CCA does is it reduces your tax payable, and therefore it's an incremental inflow. And so if it's $2,000 each year, then all I got to do is just discount $2,000 each year for 3 years. That's the net present value way. Or you could also do an annuity where you have N is 3, the payment's $2,000, the rate's 5%, and yeah, that's it. And then you compute the present value. So that's straight line. It's super simple. When you have declining balance, it's a little bit more complicated, but it's just plugging in the numbers and punching them on the calculator. So I had examples of those last week. You can go back to the replay or look at the slides or the notes. So here we get into new material. In 10.7, there's 4 special types of cash flow analysis, or project analysis. There's cost-cutting proposal, there's replacing an asset, there's equipment with different lives, and there's setting bid price. Those last 2 are students have quite a hard time with them. That's why I stretched this class over 2 classes, so I'd have a little bit more time to do more examples and explain better these 2. But let's look at the 2 simple ones first. Cost-cutting proposal, that's pretty obvious. You have a decision where you're going to do something. Maybe you're going to move part of your production, or you're going to buy a machine that does the work of 3 machines and it costs less to run and so on. When you look at a cost-cutting proposal, remember, everything we do is always what is the incremental cash flow. And there is no networking capital stuff that's going on with that kind of specific project. Replacing an asset, it's a little bit more complicated, but not that much. All it is you're buying a new machine and then you're selling the old machine. So there you would look at the cash flows how much is the outflow for me to buy the new machine? How much is the inflow for me to sell the old machine used, to salvage it? And the other thing is, how much does that reduces my operating costs? So those would be the incremental cash flows that you look at out of replacing an asset. Let me do the cost-cutting proposal example. Yeah, you have a restaurant that's considering buying a fridge that will reduce food cost by $15,000. The machine will cost $36,000 and will last 3 years. And it will be depreciated to 0 using straight line depreciation. What is the annual net income for this project if the tax rate is 34%? Well, first, let's look at, I've shown that to you before, but I'll just show you again because it's such an important equation. If you look at net income, it's taxable income minus taxes. Sorry, this is a little bit of a rerun, but I showed that to you in the first class, but it's so important. I'm sorry, I want to do it again. Net income is taxable income minus taxes. So that's taxable income minus the tax rate times taxable income. Right? That's how you figure out what your taxes are. Now, if you look at this, you can rewrite that as, if you just factor out the taxable income times 1 minus t. Remember I told you, if this is pre-tax, then multiplying by 1 minus t gives you the after-tax. You'll see this 1 minus t factor over and over and over and over again in this course. In fact, you saw it in 2504. Remember the equation for WACC? If you do, you got stuff about equity. But then you have weighted debt, cost of debt, 1 minus t. So this is where the 1 minus t comes from, because you're converting the pre-tax cost of debt into the after-tax cost of debt. So you'll see this 1 minus t factor show up over and over again. Sometimes we'll have an after-tax amount, and we want to convert it into a pre-tax amount, and then we would just divide by 1 minus t. So here, the change in net income is going to be what? What are my incremental cash flows? I will have 15,000 more of income each year because I'm saving. If my costs go down by 15,000, then my net income goes down. Sorry, my taxable income the outflow is 36,000, and it's depreciated straight line to 0 over 3 years. So that's going to be 12,000 each year. Yeah. And so this is your change in taxable income. And you multiply by 1 minus t to get what the net income is. So if my costs go down by 15,000, but at the same time I have another cost that goes up by 12, so I'm making 3,000 more in taxable income for each one of those years, and then I convert it to after tax. 3,000 pre-tax is 1980 after tax. So just cost-cutting proposal in general is pretty simple because you just look at what are you gaining minus, what is it costing you to get that gain, and then you just convert it to after tax. So it's extremely simple. I don't have an example of replacing an asset, but it's pretty obvious. It goes, similar to this kind of reasoning, where you look at, what am I gaining? What is the cost to get that gain, and so on. It's pretty simple. Now let's talk about equipment with different lives and setting bid price. Here's the reason why we need to know this kind of this equivalent annual cost for a piece of equipment. Say I want to buy a piece of machinery, but I can buy two different machines. I can buy a machine that costs a certain amount but lasts 3 years, or I can buy another machine that costs a little bit more, but it lasts 5 years instead. Which one should I pick? Well, it depends on how much more, what's your cost of capital, and so on. What it is, it's the present value of the project smoothed out, evened out over each of the years that you have. And so you're able to come up with what is a per year cost. And then if you want to compare with another machine that you can buy, you just look at instead of comparing an apple and an orange, the cost of a machine over 5 years versus the cost of a machine over 3 years, what you do is you come up with a number which is how much is that machine costing me per year? And then I look at how much is the other machine costing me per year, and obviously I pick the lowest. So you'll see an example in a second, or a couple examples. The last one, which is probably the most difficult that I see students have the hardest time with, is a bid price. Let's talk about bidding. Especially if you're a company that does a lot of business with governments, that's pretty much what you do all the time. All right, you bid for a contract. Yeah, the city wants to build a road, so they put an ad that say all the companies that want to bid, you got to submit some documents on a proposal. It's called an RFP, request for proposal. The federal government does that all the time. And then you have to specify, yes, I'm going to do this contract for, say, $100,000. And then somebody else bids and says, I can do this contract for $120,000. And somebody else bids and says, I can do this contract for $80,000. And somebody else bids and say, I can do this contract for $50,000. Then what happens is the person or the company that bid $50,000, they're the one that win. But the problem is the winner's curse. If you win, congratulations, now you have to do it at that price. You can't bid 50, win the contract, and halfway through say, oh, I'm sorry, it's going to cost a lot more. We're going to have to charge the government, say 20% more. Doesn't happen like that. Once you win a competitive bid, that becomes a binding legal contract for you to do the work at that price. So it's extremely important that you decide that price carefully. Because if you don't, you might be stuck. There's a company that blew their brains out. The company that did the bridge going from, Barhaven to Manotick or something like that, around there. I can't remember what it's called. It starts with a C. But, they said, oh, it's going to cost us, $3 million to build that bridge. And then halfway through the building the bridge, they're already bankrupt. They've run out of cash. So when you bid on something, you got to make sure that the bid price that you put in is not going to make you lose money. And the minimum bid price is the one where your net present value is 0. What that means is if you bid a price that's lower than that, the project of doing that contract would have a negative net present value. And obviously, you don't want to do that if you want to stay in business for too long or if you want to keep your job at a big company. So what we're looking for is to find what is the unit price, what is the bid price that we need in order for the project to have a net present value of 0. And then obviously you want to bid that and then a little bit more, so you can make some profit. Now somebody is going to say, well, what if I bid too much and somebody else gets it instead? Well, you're better to not win a bid than to win a bid and then do the project at a loss. Or do the project and, takes like 3 years, tons of headaches, and just to break even. Nobody's in business just to break even. There's nothing noble about a company that only, after just working crazy hard, just ends up back where they started. It's pointless. So, those are the two that we're going to, most of the material tonight is. So now I'm going to get into equivalent annual cost. So the goal is if you look at, now these are costs, I'm going to use positive values, but it really doesn't matter whether you do negative or positive as long as the signs are all on the same side. Say a machine cost me $300,000 to buy, and then each year, so the machine's good for 3 years. Each year the machine costs $10,000 to operate. Or say, maybe the first year it costs $10,000. Second year it costs $20,000. And third year costs $5,000. I'm just doing that to illustrate a point. Most of the examples you're going to see, they're actually the same. What we want to do is come up with, say we want to compare it with another machine that did this. It cost, say, $100,000, or say $200,000, and then $10,000 a year to operate. Which one is better? The answer is you got to come up with some kind of number that you can compare. So say this is machine A, and say this is machine B. You got to come up with a number that you can compare machine A with machine B. So what is, you want to use maybe total costs over the whole life of the machine? Well, what if one machine, say, lasts 10 years, but the other one only lasts 3? Obviously, the machine that lasts 10 years is going to have a higher cost over the whole, over the entire life. What we want to come up with is a single per year cost. So if you take this, what you do is you take the net present value of the whole of this whole what you do is you take the net present value of all these costs and then you take that net present value so there's nothing here, imagine a box with 0 height. You take the net present value and you want to even it out. into what the cost is each year. So then you would do the same thing with the other one. So on that one, you take the net present value of that series of cash flows, and then you even it out into equal payments each year of the life of the machine. And you do the same thing with that one. Then you compare what is the per year cost of A versus the per year cost of B, and you take the lowest. So first, you calculate the net present value of the uneven cash flows, including the large cost at the beginning, but you don't include the year zero when you even the cash flows out. So you take that net present value and you even it out over n years. So n in this case here is 3, and that other one it's 2. And they have to be equal. So that's an annuity, payments over 3 time periods. I'm going to show you an example with no tax, and then I'm going to show you an example with tax so you see how it's handled. But here's how it works. You include the present value of the CCA tax shield in the net present value of the cost of the equipment. Because if you buy a piece of equipment, then you'll get the CCA deduction, and so over the life of that machine, you'll get the present value of the CCA tax shield of each year. So that you include that as a cash inflow. And when you look at the operating costs, you use the after-tax operating costs. So in the example I have here, where you have the machine is $16,000. Well, that's the one with no tax, but it really doesn't matter. The machine costs $16,000. Well, if my tax rate is 25%, that means that really that machine is costing me 16,000 times 1 minus t, which is 16,000 times 3/4, which is 12,000. You'll see the example in a sec. So let me show you an example with no tax. So it simplifies things, a little bit easier to understand. So here, the net present value. So we have $1.8 million, and then 16,000 for 3 years. So the net present value of this whole thing is what? You got 1.8 million. And then you have 16,000. Oh, sorry, I should have. The equation would be up to 3 of the cash flow in that year, discounted that many times. So the first term, CF0, is the 1.8 million. Then you have 16,000, and the discount rate is 14. Now the summation starts at 1. And so that's equal to so what we want to come up with is we want to come up with a value that the sum of the present value of these three equal payments is equal to the 1,837,146. So what's this? That's an annuity. So what's the formula for annuity? Present value but what we want, we know the present value, we want to know the payment. So if you just reorganize this equation, you just bring the fraction to that side, the fraction is just going to flip. So the present value of our annuity payments is that 1,837,146, and then the rate is 14. We have 3 years. So there you have it. The uneven series of cash flows, which is starts with 1.8 million, then 16,000 for 3 years. That has the same present value as an annuity, which is 791,000 for each one of those years. Notice there's nothing in year 0. It's only for the years that the machine's in use. And so that's a measure of what does it cost you to have that machine for that year. And that's what's called the equivalent annual cost, EAC. So that's with no tax. What I did is I took the same question, but I added some tax into it so that you would see the exact same example, with no tax and then with tax, so you see the difference. So the first difference, I have to get rid of this picture here. So the first thing we're going to need is what is the present value of the CCA tax shield. Now, there's no salvage. Where did I write this in somewhere? Each machine is alive for 3 years before it's replaced with 0 salvage value. So in your present value of the CCA tax shield, you don't have the second term in that formula. Then you just plug in the numbers. D is 40. So if you have a machine that you have a life of 3 years and it's got no salvage value, but the CCA is 40%, then you will get $312,865 in tax savings. Then the cost each year, so the cash flow each year, call that CI or say CT. Remember that anytime we look at decisions, the only thing we ever take care about is after-tax cash flow. So if you're including taxes in that, and the machine costs $16,000 a year to operate, that's going to go into your income statement, and so that's going to be deducted before you get to taxable income. And so something that's costing you $16,000 after tax, if your tax rate is 25%, in reality, that is costing you after tax only $12,000. So that's the other difference between equivalent annual cost with no tax versus tax. The first one is that you got to account for the CCA tax shield. The second one is that the costs each year are after tax instead of pre-tax. Then you do the net present value. So here the net present value is so the cash flow in year 0, you just bring to the present the CCA tax shield, and so you'll spend 1.8 million, but in present value terms, you save 312 from having the CCA deduction. So that's the first part. Then so the way to do this, you don't have to to write it out or do it with the calculator for each term. All you got to do is this is your cash flow for year 0, and then this is C01 is 12,000, and then the frequency is 3. Make sure you know how to use the frequency feature in the cash flow mode of your calculator. Instead of saying 12,000, then 12,000, then 12,000. For 3 years, it's not that bad. Let's say you had 5 years. 12,000, 12,000, 12,000, 12,000, 12,000. Instead, all you got to do is say 12,000 repeated 5 times. It's a lot quicker. So there was a question earlier about, how do I do the multiple choice quicker? It's to see these kinds of things where, it's cash flow, so you just use the frequency feature and it takes like 5 keystrokes and you're done. So the net present value of that is 1,514,994. You don't need to. I just showed that to you so you would see it, but you don't need to do it every time. And the way you can look at it is that it's the EAC, and here is the present value. So the EAC plays the role of the payment in the annuity, and net present value is the present value of the annuity. So now it's 1,514,994. The rates stay the same, and you end up at 652,556. So you can see that When we did it with no tax, the equivalent annual cost was $791. But when you do it with tax, because of the fact that one, you get the CCA tax shield, and two, the operating cost, you get a deduction, a little bit of a tax shield from that too. Then in that case, the total present value of the cost of the whole machine over its life is 1.5 million instead of 1.8, and the cost each year is 652 instead of 791, which makes sense because you have some tax savings, so you would expect, with tax, so it costs you a little bit less. So that's a single example with no tax and with tax. So let me show you how you would use that. What's the purpose of doing that? You might get a question on a quiz, a midterm, or a final to do an equivalent annual cost of just one machine, just because it's quick, just so we can see how you do it. But in reality, the point of doing this in the real world is to come up with the EAC of 2 different options, or maybe 3 or 4 options, and then pick the cheapest one. So here we have a car company that's looking at 2 machines. The company has a 16% rate of return, and that machine, both machines would belong in a 30% CCA class. So your rate of return is 6% or 16%? 16%. You have machine A. And machine B. So first, what you want to pull from the question, you want to know these 1, 2, 3 things. What is the life? That's in years. So machine A has 4 years. Machine B lasts 3 years. You want to know what is the investment? So in the first, for machine A, it's 427,000. For machine B, it's 390,000. You want to know what is the operating expense? So in the case of machine A, it's 13,000 per year. In the case of machine B, it's 6,500 per year. And so now you have this data. So what you'll do is first you want to find what is the present value of the costs, or you could call that net present value. And then you want to find what is the EAC of each one. So the first one, I'll skip writing the formula with the variables in, but remember that for the midterm, the way it works is you need to write the formula with the variables, the formula with the numbers plugged in, and then the answer. And normally what we do is we put roughly a third part marks on each. So if you skip writing the formula with the variables like I'm about to do, you would lose a third of your marks. It's just a little bit short on space.
is with that tax?
Yeah, it says there, the last one, ignore taxes. So I'm doing one where there's two machines, but there's no taxes. Even though they throw some fluff in saying, you know, there's this 30% CCA class and the tax rate is this. And actually, no, they don't give the tax rate. You can even do it with tax anyway because you're not given a tax rate in the question. But it says ignore taxes at the end. The last part there. So that's equal to 165, 599. So that's how you figure out the equivalent annual cost of A. I'm not going to do B because it's pretty obvious, but I'll just give you the number. It's 404, 598. And the equivalent is 180, 151. So you can see that over its life, machine B is cheaper, but per year it's actually more. It's costing you less, 404 instead of 463 over its whole life, but it's only lasting 3 years. So when you even out this number that's smaller over a smaller number of years, it actually ends up being more than option A. What this says is if you buy machine A, in present value terms, it's going to cost you $165,000 a year for that machine. But if you buy B, it's going to cost you $180,000 a year. So obviously you would pick A. I'm sure that if you're business students by now, you know that you want to pick the option with the lower cost. So that's the purpose of equivalent annual cost. It's to pick between two different machines. Like I said, you might get it on a quiz, midterm, or final to do the equivalent annual cost of just one thing, but that's just because, you know, we want to save you some time not to have it to do it twice. But the reason to do that, it's to decide between two possible options. Okay, so we'll take a break here. Okay, so it's 7:55. Let's continue. So now we get into bid price, probably the most complicated question or problem type of the beginning of the course. It gets a little bit more complicated into, say, chapter 16 and 21, but this is kind of a local peak here that we're going through. Bid price. So I talked about the theory a little bit earlier, which is the reason why you care about this is if you bid on contracts, you want to know what is the price that you bid. And you're better to bid a higher price and not get a contract than to bid a lower price and now be legally bound to have to deliver at that price. So it's I've seen companies that, you know, they bid high all the time. Back in my old government days, you know, there's companies that just bid high all the time, and then they just hope that, you know, at least one of them hits or something like that. Because if you just, that's this from the point of view of the government, what they're trying to do is have all the suppliers basically, you know, fight amongst each other and only get the lowest one. But like I said, there's that winner's curse. You don't want to be the lowest price bid if you're not going to be able to do the project at a profit. So the bid price, it's called in the textbook bid price, but really what that is, it should be called minimum bid price, because that's the bid price at which the net present value of that project you're bidding for is equal to 0. So yeah, it's nice to break even, but you know, you don't get a lot of points in the real business world for a company that just breaks even. So what you want to do is find the unit price. Something that students confuse sometimes. They'll figure out a number, and it's going to be the sales for, say you're building, 5 bridges. It's going to be the sales for all the bridges put together. What you want is what are you bidding per single unit. So we want to find the unit price that gives net present value of the net capital spending plus the operating cash flow plus the changes in net working capital and the CCA tax shield. All of these present values put together have to be equal to 0. So it looks something like this. I'll come back to, I call this a recipe or something. I'll come back to this. I'll start into an example. It's going to make a little bit more sense. So here's the example. You're bidding to build 5 playgrounds for the next 2 years. You're going to purchase $62,000 of equipment, straight line to 0 over 2 years. But you're going to sell the equipment for $39,000 at the end. What does that do? That creates, remember, recapture. If you straight line to 0 over 2 years, but when you go to sell the machine, you sell it for $39,000. So that's going to create a recapture. I'll show you how to do that in a bit. But whenever you see something like this, straight line to 0, the first thing you want to check is if there is a salvage. That means that I'm in a situation from the point of view of my tax return where I have a piece of equipment that's fully depreciated, but I get to sell it for some amount of money. That some amount of money, the government never gives tax-free gifts. If you sell something for more than you have it depreciated on your books, that creates recapture, which is then included in taxable income. So you'll see when we do the CCA. In Chapter 10, I realized when I started doing this course, I would put in some Excel examples, but then people said, don't bother with that because, when I write my exam, who cares? I'm not going to have Excel with me. But in general, when you do a lot of these problems, there's some kind of spreadsheet that you set up. I'm just going to do it on the board. In the real world, you use Excel, but you want to get used to writing out that table, just the process of thinking through a problem and capturing all the different pieces of information you got to deal with. So with this case here, I'm going to have one column for the present value, one column for year 0, for year 1, and year 2. And then, what are the things that are included? I got operating cash flow, net capital spending, changes in net working capital, CCA. That's not actually a cash flow. I'm just including it there because I'm going to want to figure out my CCA tax shield. And we know that the net present value of all of these things put together, we want it to be equal to 0. So we don't know what the present value of the OCF is and what the OCF of each year. Bid price is a little bit running, I guess maybe one reason why students might have a hard time with it. It's a little bit about running a Chapter 10 problem backwards. Right? Instead of having the cash flow for each year, then figuring out the present value, and then all your other present values, and then figuring out what is the net present value of the whole thing. What you do is you start with a fixed net present value of 0, and you want to walk the problem backwards to figure out first what is this number, and then what are those numbers. So let me show you. First, the net capital spending is $62,000 in year 0. Actually, in here, that one's actually going to be 0. So there's only operating cash flows in the actual years. And at the end, you will get plus 39,000. So in 80 or 90% of Chapter 10 problems, this is the kind of table that you want to set up. Operating cash, what are the components of cash flow from assets? Operating cash flow, net capital spending, changes in net working capital, and CCA tax shield. So the net working capital, remember I told you this is the simple way that you see that kind of situation. There was an example last week where the net working capital was a percentage of sales, and so through the life of the project, as the sales went up and then went down, there was the net working capital change every year. But this is more complicated. This is typically, the only thing we only use that, say, for a group assignment, because it's a little too complicated to do that for a quick quiz, midterm, or final. So typically for the net working capital, you need a certain amount of net working capital through the life of the project. And what it is, it's an outflow in year 0, and it's an inflow of the equal amount at the last year of the project. Okay, so first, if you look at that recipe there, let's find the present value of the net capital spending. And again, I'm just gonna, I'm not gonna put the formulas with the variables there, but remember that at the midterm and the final, you have to write them out because that's the 30-year marks. It's just that because I'm filming, I only have one board. I'm a little bit tight on space, but make sure you don't forget to do that in. Why don't I just do it? So the net, we got minus 62,000, and then the net, and then an inflow of 39,000 at the last year. So the present value of the series of cash flow minus 62,000, 0 plus 39,000, discounted at 15. That's equal to minus 32,000. Now, same thing for the net working capital. So for the net working capital, the changes in net working capital, you got an equal amount, but that amount into the future is worth less. So discounted back to the present, that plus 12,000 is going to be less than 12,000, but that minus 12,000 is always going to be, because you divide by 1. And so you will always have a negative thing there, and that right there is the amount of interest you're paying to have that 12,000 locked into that project for the life of the project. But that's why the present value of the net working capital is a negative amount, because you have the same amount here, but it's further into the future, so it's worth less. So it doesn't perfectly balance to be equal to 0, right? You're not summing these rows, you're taking the present value of that row. Because if you were ignoring present value, that would just be 0 there. So that's why it's negative. Then let's look at the CCA. We have that the equipment is 62,000 and it's depreciated straight line to 0 over 2 years. So in the first year, that's not an actual cash flow. I'm just using that as a intermediate calculation to show you. So it will be 31,000 the first year. And then if it was straight line to 0, it would also be 31,000 the last year. But you sell the machine for 39,000. And so the CCA for that year is going to be the 31, but you're going to include the amount of money that you're getting back from, sorry, not that you're getting back, but the amount of money that you're going to pay extra in taxes. So you have 31,000. If you look at that, you get to here, you have a deduction of 31,000 for the last year, but you sell the machine for 39 more than it's worth right now, which is 0. And so you will have a negative 8,000 in your CCA for that year. And so what is the CCA tax shield from that? Well, it's 31,000 times the tax rate. And then that's minus 2. So that's your CCA tax shield for each one of those years. You're going to save $10,500 in taxes the first year from having a $31,000 deduction. And in the last year, you're going to have to pay an additional $2,700 in tax because you had a deduction of $31,000, but you sold the machine for $39,000, so that created $8,000 of income. And so that $8,000 of income taxed at 34% is $2,720. So if I take the present value of these two, it's just the same as these. I'll skip writing it out in full. It's not really showing you anything. So it would be 10,540 divided by 115 minus 2,720 divided by 115 square gets you 7,109. So now we're at step 4. We know the present value of our CCA tax shield. We know the present value of the change in net working capital. We know the present value of the net capital spending. And so we know that present value of operating cash flow, which is this amount we don't know yet, plus present value of net capital spending, plus present value of changes in net working capital, plus present value of the CCA tax shield, that's equal to our net present value. Well, we know that that's equal to 0. And so we know this, we know that, we know that. We want to figure out what this is. So reorganize the equation. So now we plug in the numbers. And you got to be careful here because you got a lot of double negatives. But present value of the CCA tax shield is positive, whereas those are negative. So you got minus a negative number, minus a negative number, minus a positive number. And that's equal to 28327. So now we know what is the present value of that first row. So now we have the present value of the first row, but we want to figure out what is the operating cash flow in each one of those years that's going to give us that net present value. It's the same as what we did with equivalent annual costs. It's just the the inverse of the annuity formula. Sorry, I got to erase this. Basically, all that is just saying that you got 0 here, so you got to figure out the number in that box that makes that column 0. Okay, so now we know the present value of them, but we want to figure out what is it for each one. So now we have what is the operating cash flow each year. That's not what we're looking for. We're not quite there yet. So far, that was step 5 here. So far we've gotten as far as step 5. So we know what the operating cash flow for each year is, and what we want to figure out is what is the unit price of, what are we building? Playgrounds. What is the price per playground so that the operating cash flow is that 17,424. So right, operating cash flow is sales. But instead of sales, we'll write it as P times Q, right? What is the unit price times what is the quantity? What we could do is, figure out the sales for the year that have that operating cash flow and then divide. But I'm just showing it to you from, clean from the beginning. We don't have the depreciation tax shield part because we handled it. We already handled the depreciation tax shield. The whole idea of operating cash flow, remember when I showed you the way to do it with and without. You can split handling the depreciation, or sorry, the CCA tax shield. But what's important is that you only do it once, and obviously that you do it at least once. There's two mistakes you can make. You not handle it at all, or what I see actually more often is people double counting it. So you handle the CCA tax shield here, and then you also handle it in there. So if you did that, you would end up double counting the depreciation tax shield. You've already handled it. That's the idea of the depreciation tax shield method, is that you can, de-intertwine. That's not a great English word, but you can, if somebody has a thesaurus, they can help me out. But you can untangle the handling of everything else from the handling of the depreciation. So that's what we're doing here. And then in this case, I'm handling the depreciation early in the problem. And so when I get to my OCF, that's the version of OCF where the depreciation's already been taken care of. If I didn't do that here, then I could use my depreciation tax shield there. But it's complicated because the depreciation tax shield is not the same every year. So you couldn't really do it, plus DT, because the D is different for year 1 than it is for year 2. So that's the best way to handle this. Do you have a question?
Yeah, I just have a question for the operating cash flow payments. Are they negative 17 or positive?
No, positive. Yeah. Because you have negative, negative, positive, and you want the whole thing to be equal to 0. So the present value of that series of cash flows is positive, and so each cash flow is positive. Okay, so we're at the end. So now what I'm doing is solve the operating cash flow equation for the quantity. Sorry, there's a mistake there. I should have said for P, not Q. Made a mistake on that slide. So this should say here, solve OCF equation for P, not Q. I made a mistake there. Sorry. Okay, so I have that equation. I know this. I know this. I want to figure that. I know this, and I know that. So what I want to do is reorganize this equation. This should be, a pretty basic, high school math skill. If you still have problems with reorganizing equation, this is something that you need to work at, because you'll see that over and over again in this course and in 3rd year and 4th year. So here, let's rewrite that equation as P times Q minus VC minus FC is equal to operating cash flow divided by 1 minus T. And then just take those and bring them on the other side. And then take the Q and divide the whole thing by Q. And so that's equal to, sorry, did I hear a question? Was there a question? Oh, okay. OCF is 17,424. 1 minus the tax rate is 1 minus 0.34. The variable costs are 49,000 times 5, and the fixed costs are 18. And then you take the whole thing and you divide by 5. And finally, we're done. So this is how you do a bid price type of question. And hint, hint, nudge, nudge. It's quite common to see something like this as a written question either for a midterm or a final. Either equivalent annual cost or bid price or both. Yeah.
Is that blank after a P or is blank?
Sorry?
Is that blank after a P or is that supposed to?
It's just because instead of, I was just saving some, an extra row. I could have put one more row where I had P times Q minus VC minus FC. It's just I reorganized the equation on the fly there. I can show you after if you want to see, like, really the equation is really that. Just because I had the VC and the FC and then I brought it to the other side. Okay, so this is it for new material today. As always, I have more examples. I've explained to you before what it is. I won't repeat myself, but I just have more examples for the rest of today. And I'm going to do one equivalent annual cost and one bid price. There's no new material. It's just more of the same. But if you want to stay back and see a little bit more, you're welcome to. If you want to leave, go ahead. I'm not offended at all. So I'll take just a quick 5-minute break. If you're going to leave, though, I ask you that you do it, fairly quickly. Don't just, take like 15 minutes to drag out. Okay, we have 2 examples to finish tonight. So the first one, equivalent annual costs. This was actually the question on the midterm 2 or 3 years ago. I can't remember, maybe 2 years ago or last year. Anyway, this is typical of a written question that you would see on a midterm or a final. So you have a company that's looking at buying either System A or System B. And one of them lasts 3 years, but the other one lasts 4 years. So what you want to figure out is what is the equivalent annual cost of each one. And then once you know that, then you pick the one with the lowest one. So first, let's look at so in this case here, we do have taxes, but it just says ignore the half-year rule. So when you do straight line, you wouldn't have the half-year rule in the first year of your straight line depreciation. So the present value of the CCA tax shield is going to be the CCA tax shield, right? CCA times the tax rate. And that's an annuity. You get that for each year. So the CCA, in this case, is $5,800 over 3 years. The tax rate is 37. And then the annuity factor is 1 minus 1.12 to the minus 3. So remember that System A has 3 years. So when you're doing your annuities for System A, you're using 3 years. But when we do the annuity for System B, we're now going to have 4 years. So that's going to be different. It's not, that number there is the number of years that your machine is good for. So this here that's your after-tax cost. Right? You're given the cost pre-tax. It says here as an annual before-tax maintenance cost of $350. So the machine costs $5,800. You will get, in present value terms, $1,718 of CCA tax shield over that life. And the before tax cost is $350, and so the after tax cost is going to be $350 times 1 minus 0.37. And then the discount rate's 12. So the net present value is 4,611.49. So that's that right there, 4,611, well, 50. Close enough. So that's the net present value of what's happening here is this. You have 5,800 and then 300 times 1 minus 37. Can somebody just calculate that quickly for me? What's 350 times 0.63?
That's 220.5.
Okay, 220. And here's 3. You said 220 or?
Yeah.
So that's the situation you have for System A. You pay $5,800, and then your costs per year after tax are $220. So that series of cash flows, the net present value of that is $4,611.49. So now what we want to do is even out that $4,600 over 3 years. So what we have is a regular annuity with 3 payments. Sorry, I just need to go find some chalk. Right, sorry for the delay. So the equivalent annual cost of A is 1919 or 1920 if you round up. So that's how you figure out the equivalent annual cost of system A. So now you got to find similarly the same thing for system B. So what's going to change is what is the CCA deduction each year, how many years do you have? The answer going to be here. That's B. So this time the CCA deduction is going to be 6,400, but now it's over straight line over 4 years, and it's 4 here. So that gives you 1,798.11. The investment for B is 6,400. You save 1,798 and 11 cents in from the tax, the CCA tax shield. The pre-tax maintenance cost for B is 280. And so the net present value for B is 513768. So that shows up here. And then there's a 4 here. So total 1691. And so the equivalent annual cost of system A was 1,900, and of system B is 1,691. So obviously, if you like keeping your money, you would pick B because it's costing you less per year. So the last example for today is the bid price. Now, the bid price that I did in the main part of the lecture had straight line depreciation in it. I picked that one there because it has declining balance, so you see a variation of the problem. So let's set up the table. What is our discount rate? 15. So you want to know the present value and how many years do we have? 5 years. When you have a lot of years like that, what happens is you have a certain pattern where the last year you're going to have everything that comes back in, right? You're going to have your salvage, you're going to have your net working capital that's coming back. But what happens is in the middle years, they're always going to be the same. So it's a little quicker to say, so there's always a year 0, but then we'll just say year 1 to year 4. Instead of having to write out the table, you know that for year 1 to year 4, it always looks the same. And then you have year 5 where something else is happening. So the first thing is operating cash flow. So we don't know yet what the present value is. Well, at least we know that that's 0. We don't know what that is. We don't know what that is. But that's the same in all 5 years. Then we have net capital spending, changes in net working capital, and CCA tax shield. So we know that the series, the sum of the present value has to be equal to 0. So let's figure out what those present values are so that we can figure out that one. So first it was the net capital spending. You have minus 1.6 million in year 0. And then for at the last year you have 800,000. The net working capital, you got 120,000 that you need. So that's going to be an outflow of 120 in year 0 and an inflow of 120 in the last year. Then for the CCA tax shield, there's not going to be any we actually use the 0. There's no CCA tax shield in year 0, but you don't really care what the CCA and the CCA tax shield is each year. That's the power of the present value CCA tax shield formula, and that you can figure out what goes here without having to, calculate your entire depreciation schedule and then taking the net present value of each one. So first, the present value of net capital spending, that's going to be, I'm not going to write out the formula in full because you can go back, you'll see it, but it's pretty simple. It's minus 1.6 million plus 800,000. Why don't I just write it out? And you're going to discount that back 5 years. So that's the first, the second line. Net working capital. So you'll have the change in net working capital in year 0. Plus the change in net working capital in year 5, discounted back 5 years. And so that's equal to 60,000 minus 60,339. So now we have the number that goes here. So the last one is, the number that's in here is the present value of the CCA tax shield. Because that line is CCA tax shield, but then that column then would be the present value of that line, present value of the CCA tax shield. So what's that equal to? 3. and you do have salvage here. Salvage value is 800,000. So salvage value is going to show up in two places. It's going to show up in the net capital spending, and it's going to show up in here. Because once you salvage something, then you don't get the CCA tax shield after that. So that's why this is the present value. This part, say you salvage here. And so that would be your S5. This first part of the formula is the whole thing. If you own the asset until it went to 0, what you do is to get this part, what you do is, I could write it this way. Minus the part that you don't get to deduct. So that's the present value of the CCA. That's why you have that second part. When you have salvage, once you salvage the asset, you don't get the CCA deduction after that. So you lose the CCA deduction for all the years after you salvage. That's why there's that second part in the formula there. So now you plug in the numbers. There's a typo in the notes. So that's equal to 248. It's 60. So now that I know all the elements in my column except that, and I know they got to sum up to 0, So now you know what the present value of the operating cash flow is when you're breaking even at net present value is equal to 0. Right? If you sum up that column, it should be equal to 0. Now, what I saw where people confuse the most, where students confuse the most this problem, is they skip the part where, okay, now I have the present value of the operating cash flow, but I need to distribute that operating cash flow over the years. What a lot of people did is they just took that number as this is what I'm making every year. So don't miss the intermediate step there. What I'm saying is a lot of people confused 4 and 5 and did them together, mashed up in some kind of weird way, only did 1 or whatever. What's actually going on is first you need to figure out what is the present value of them, and then you figure out what is the operating cash flow for each year. So that was that's step 4. So now I'm going to do step 5. Or what I call 4. Yeah, 4 is finding this part, and then 5 is finding the operating cash flow for each year. So this is just back to the annuity formula. Then reverse, where you're trying to, instead of knowing the payment and having to figure out the present value, you know the present value and you want to figure out the payment. So it looks like this. Right, this has the role of the payment, and this has the role here of the present value in the annuity formula. And you're spreading that $1 million over 5 years. So that gives you 302, 414. So you know for year 1, year 2, year 3, and year 4, and year 5. So this is the 5th step. And so now that we know what the operating cash flow is, another mistake that I saw, not as common, is people just took that 302, divided it by 5, or 10 in this case, and think you're done. What you have now is what is your operating cash flow at the break-even net present value is equal to 0. You want to use the operating cash flow equation to figure out what that unit price is. So this is the last step. Know that operating cash flow, I'll do it in full there. So it's sales minus the variable costs minus the fixed costs times the tax rate. So I'll rewrite this as P times Q, because what my sales are is just what the price times the quantity that I have. So now I want to solve for P. So the first thing is I bring my 1 minus T underneath here. So I'm left with P times Q minus VC minus FC is equal to OCF divided by 1 minus T. Then I can further simplify this part. So that P times Q is equal to OCF divided by 1 minus T plus VC plus FC. But I still want to, sorry, is there a question? No. But I still want to solve further. I want to figure out what is my P. So okay, now I know all these things. I can just plug them in. So my operating cash flow is 302, 414. The tax rate is 34. The variable costs are 815. So that 815 is 81,500 times 10. And then the fixed cost is 700. And it's all of that divided by 10. And so that's equal to, final answer, 197,320. A little bit over time, sorry. So that's it. I'll see you next week.